A large part of successful trading comes from mastering your mind and your thoughts. Let's talk about the 3 most common psychological mistakes traders make. So let's go ahead and get into it. Psychological trading mistake number 1, FOMO trading. FOMO is an acronym for fear of missing out. Let me paint the picture for you. The FOMO trader is typically very optimistic about each and every trade, because this trade could be the one, right? Something about this trade looks so much better than all the others, so it has to be the one. If I miss this trade, there may not be an opportunity like this one for a while. We can all agree how silly that sounds. Of course there's going to be more opportunity around the corner. But although it sounds silly and obvious, the reality is that this type of thinking affects so many traders, mainly because they don't even realize it's affecting them. And it's a huge problem because it can cause you to do 2 things. Number 1, it can cause you to take every trade you see, even if it's not that good of a trade setup. Number 2, and this one is even worse, it can cause you to increase your position size on a particular trade, because if this trade does end up being all that it's cracked up to be, why would you only want to make a few hundred or a few $1,000s on it? Screw that, that's chump change. Let's swing for the fence. But what happens when this trade turns out to be nothing special? And despite how much it seems like there's no way you can lose money on it, it turns into a losing trade. And now you have tons of your capital invested and are sitting on a huge loss that will be almost impossible to come back from. Psychological trading mistake number 2, revenge trading. These are the types of traders who can blow up their entire trading account and lose everything in just a day or a week. After taking a trading loss, revenge traders will throw everything they know about proper position sizing out the window and will trade like a madman just to make back that loss. Now, this may work once or twice and you'll come out unscathed, but if you keep this up, you'll get crushed, bad, and it's going to hurt. The market doesn't care about you or your money, and you're going to be the one 100% responsible for it if your revenge trading causes you to lose everything in your trading account. Psychological trading mistake number 3, gambler's fallacy. Now, this might not necessarily be a psychological mistake, but rather just a very common misunderstanding of some basic probabilities. And then it will cause you to make very poor trading decisions, and in some cases this one can also compound and cause very big losses. Now, this actually spans far past just the trading world, and as you can probably guess by the name, it's most commonly associated with gamblers. We certainly don't want to treat our trading as gambling, so let me show you how to avoid this common mistake that so many traders make. A quick Google search will show you the definition of gambler's fallacy, but let me put this in layman's terms that anyone can understand. We all know that a coin flip is a 50-50 bet. So if you flip a coin 10 times, the expected outcome would be 5 heads and 5 tails. But although it's expected that the same number of heads and tails will show up, we know that the actual number can deviate in either direction. But let me ask you a question. Let's say we plan on flipping a coin 10 times, and the first 5 coin flips all land on heads. What is the 6th coin flip more likely to land on, heads or tails? If you said tails, then you, my friend, have fallen victim to gambler's fallacy. Let me explain. The expected outcome of 10 coin flips is, of course, 5 heads and 5 tails. We just covered that. But rolling 5 heads in a row does not change the probability of the next coin flip. The probability of the next coin flip is completely independent from the past results. So, what is the 6th coin flip likely to land on after 5 heads in a row? The answer is that one is not more likely than the other. It's still a 50-50 bet. Gambler's fallacy refers to the thinking that a series of events will somehow affect the outcome of the next event, as if there was some sort of balancing force at work, and in this example the coin somehow knew that it just landed on 5 heads in a row, so now it should land on tails. And this gambler's fallacy actually applies to many other parts of life as well. A few examples are someone who flies a lot, thinking they are somehow working their way towards a crash, even though each flight is independent of the last. People at the casino who see that the roulette wheel just landed on red 10 times in a row, so now they start putting their money on black, even though the previous spins have no bearing on what the next spin will be. And finally, it also applies to trading, and so many traders fall into the clutches of this fallacy. If you have 5 losing trades in a row, this does not mean that the next trade will be a winning trade just because you feel like the losing streak has to end soon. Many traders tend to increase their position size after a losing streak because they feel their luck has to turn around soon. But the reality is, you're just increasing your risk on a trade that has the same probability of success of all the ones you just lost money on. The market does not know or care if your last few trades were losers or winners. The stock market is not a place for weak, emotional people. Make sure your own worst enemy doesn't live between your ears. So, alright guys, if you enjoyed the video, make sure to click the like and subscribe button below. So, I will see you there.